Hello everyone, good morning. I'm Nick this side. Today we are going to discuss about the fundamentals of microfinance, its uses, its importance, and everything. So let's get started with it. So what actually a microfinance is? Microfinance helps to deliver the financial services, especially the small loans, savings, microinsurance, and payment service to especially the low-income individuals and micro entrepreneurs, who are excluded from the formal banking. Its core objective is financial inclusion, which is reduce liquidity constraints, smooth consumptions, and enable productive investment. The sector blends social goals with market mechanism. The top two pioneers of microfinance are Mohammad Yunus and Grameen, who approached the popularized collateral-free, which is the basis of the microfinance. So, what are the core principles of microfinance? The three core principles of microfinance are collateral-free lending, which includes credit extended without a traditional collateral, relies on payment incentives and alternative guarantees. Second is group-based models. It includes small peer groups, basically 5 to 10 members, who provide more mutual accountability, and it also reduces the monitoring costs and also improve the repayment rates. And the last one is regular repayment rhythm, which includes short cycles, mainly weekly or fortnightly. It enforces financial discipline and also it reduces the default weeks and helps the enable to align the cash flows with borrower businesses. So the main progressive lending scenario is start small, increase the loan size with demonstrated repayment, which reduce the financial hazard and credit risk. In this slide, I am going to discuss about the collateral-free and group lending mechanism. Group lending substitutes social collateral for assets. Its typical structure is 5 to 10 members. Joint liability features it also provides and also provides a staggered approval. Peer monitoring and public repayment records create reputational costs that discipline borrowers. Field officers facilitate sign-up, training, and weekly collections, anchoring the relationship between lender and the community. So therefore, group liability reduces the information asymmetry but can transfer the social stress, which is also designed to balance the enforcement with borrower welfare. Now we are going to understand the lending methodology, which starts from client identification. In this phase, we map the market, group formation, and baseline assessment, primarily the relationship between behavioral information rather than formal credit score. Second is disbursement and monitoring. Small initial disbursement, frequent repayment meetings, those steps are center-based collection, and also it includes field officer oversight is central. And third is graduation and scaling. It includes conditional increase in loan size, which are tied to repayment history, and the cross-selling of savings and insurance products. Therefore, it reduces the transaction friction while maintaining a rigorous, low-cost monitoring to sustain a portfolio quality. In this slide, we are going to discuss about the interest rate, which is why microcredit costs more. Microloan exceed the commercial bank rates because per loan fixed costs are high, which includes client acquisition, weekly collection, and the salary of the field staffs also. Loans are smaller, which includes low principal over which costs are spread, and operational intensity, which includes doorstep services and also training is substantial. Additionally, risky informal sector where incomes require closer monitoring and cushion for the defaulters. Therefore, it does not mean high interest is equal to exploitation. If pricing is transparent, it covers the real cost and enables a sustainable lending that expands the access. Regulation, competition, and product innovation can compress the effective rates over the time. Now we are going to discuss about the various risk management techniques. The first one is the group guarantees. It includes a peer pressure and mutual liability, lower the moral hazard, and effective when groups are cohesive and voluntary. Next is diversified portfolios. Sector and geographic diversification reduces the correlated shocks to portfolio performance. Next is frequent monitoring. Short prepayment cycles and field visits provide early warning of distress and allow restructuring. And the last one is progressive lending, which limits the initial exposure, rewards with the good behavior for correctly payment of loan in time. Now let's discuss a case study on this. First one is the Grameen model. Grameen Bank pioneered group-based collateral-free lending targeted at women. Key outcomes were Strong repayment rates driven by social collateral, significant poverty alleviation narratives, and also demonstrable empowerment effect for borrowers. The operational principles include weekly meetings, simple products, and intense field engagement. While social benefits are real, research emphasizes the heterogeneous welfare impacts. Effects vary by context, product design, and complementary services, which include savings and training. The next case study which I'm going to discuss about the India, the rapid growth and regulatory lessons. India's microfinance landscape features success stories like Bandhan's transformation from MFI to bank and the crisis of Andhra Pradesh 2010, over-indebtedness, aggressive collection practice and the regulatory backlash. The lessons from these case studies are rapid market expansion without consumer protection can produce social harm. Good governance, transparency, and calibrated regulation are mostly essential to sustainable growth in the microfinance sector. Therefore, the policy implication, the balanced financial inclusion with borrower protection includes supervision, interest rate transparency, grievance redressals, and data sharing frameworks. Now we have come to the last, which includes the conclusion and the key takeaways of the microfinance. First is trust plus discipline and monitoring. This microfinance succeeds wherever social capital, repayment discipline, and the robust monitoring converge to a low information asymmetries. Next one is design the matters. Product features, which includes loan size, repayment frequency, group structure, and the fees for shape the welfare outcomes and the ethical design to prevent harm. And the last one and the most important one is regulation and innovation. Effective regulation and digital fintech, which includes mobile payments, alternative credit scoring, can reduce the cost, increase the transparency, and expand the reach responsibly. So, for us, it is essential to prioritize the evidence, iterate the product design, and align the incentives, which should include both sustainable and productive welfare. Therefore, microfinance is very much suitable for the lower and middle income class. Thank you.